Welcome, everyone. Here we are for a meeting of the Income-Based Education Tax Study Committee, which I believe we refer to as IBETs.
Just like that.
Just IBET. Wonderful. Got started a few minutes late, but I am sure we will make up the time somewhere delightful. And Senator Pearson is joining us on Zoom and will be here in the real life in a few minutes. We are going to spend most of our day running through an outline, which is posted on our committee webpage and was emailed to everyone, that staff was kind enough to put together for us, that essentially runs through all of the decisions that we think we have probably made and the decisions that we probably have not yet made. For the decisions that we have probably made, we want to confirm that we have made those decisions and haven't made assumptions about those decisions. They did the best they could based on conversations that they've heard us have. And then for the decisions that are left, I think some of them we should and could spend significant time on, and some of them are more administrative details. And while we probably could spend hours on each one of them, it is not in our best interest, if we are ever going to finish our work, to spend hours on those. And so, we can always defer to the legislature to figure it out. We can always defer to the commissioners to figure it out. We don't need to answer every last question, but I think we've all been clear going through this that we are not figuring out if we should do this, we're figuring out how we're going to do it, because that's been some of the missing piece of these conversations up until now. And so as much as we can iron out on details, the better off we are. So Julia and Abby are going to, does anyone have any questions or announcements or anything like that before I dive in?
I just,
Do you want some pieces of paper?
yeah, that'd be awesome.
We're down there. Oh, there wasn't it.
Oh, down here.
There are pieces of paper at the end of the table. And so as we're going through on each sort of item here, I might be slightly more assertive than usual in saying, okay, we're going to wrap up this piece and hold it, or we're going to hold this conversation, because some of the pieces connect to each other. And while they are sort of linear in their presentation, sometimes it makes sense to hold one until we address another. So please bear with me through that process. And then we're going to have at 11:30, we're going to hear from Jake, who was able to do fuller modeling on that merge of homestead declarations and income. Okay. Starting at the beginning.
Okay.
Please.
So for the record, Abby Shepherd, Office of Legislative Counsel. This document was prepared, as the chair just mentioned, based on your discussions. What is in black in this document is where we believe there is some consensus or a decision has been made. What is in red is where there's still a decision point and a policy decision to be made. A lot of these, the way it's structured was attempting to be linear. Some of these overlap. And if you do have a question it might be addressed somewhere else, there is a little bit of repetition, but not much. We've tried to separate it out and organize it systemically, so there are categories to approach what is a very complex, entirely new structure. So again, this is based on our understanding of your discussions and is not any sort of policy proposal coming from either Legislative Council or JFO.
And the goal of today, I'm sorry I didn't start with that, is that before our next meeting, we will have enough of a rough draft of our report that we can share it with stakeholders so we can receive feedback from stakeholders at our next meeting.
Oh, yes. I printed in black and white, so I'm actually going to steal this. Thank you. Thanks, Sophia. Okay. So starting on page 1 of the document, the first category is labeled education income tax. So this looks at if a new income-based tax were proposed and enacted, how could it potentially be structured? And based on prior committee discussions and meetings, what has come out of that as a decision point would be to have an education tax structured with progressive income tax rates and brackets that would be imposed on the AGI, the adjusted gross income of all individuals receiving Vermont income in the state. So that would include residents, part-year residents, and non-residents, which follows the personal income tax structure. I did note, as you have heard, that there are constitutional limits to what type of income can be taxed by Vermont. So that's only Vermont source income. And I've included a lot of citations here if you do want to go look in the statute to see. It's also my own shorthand to help me with any legislative drafting. What is in red on the second main bullet point is what are those rates and brackets? You did see an option last meeting that was presented by JFO that did present rates. However, those are not set in stone, and there are enough other variables that those particular rates aren't shown here. They are in that presentation for reference. That's just one example. If other sort of levers were pulled, those rates would have to change. I don't know if you have any other comments on that.
No, Julie Richter, Joint Fiscal Office. The only thing I would add on that is all of the modeling that was conducted was based on that rate and bracket structure, but it assumed a few things that are not consistent with what's in this document. For instance, that modeling did not include non-residents. It was only looking at residents of Vermont. And also, as we move forward in the document and are thinking about exemptions or other folks that you may or may not want to have this tax apply to, of course, that would also impact the rate structure.
And so my understanding committee is that we can't decide on rates and brackets until we decide on essentially everything else that outlines this that we're going through today. And even the brackets, while we sort of talked about the number of brackets we would like and the shape of the curve we would like, given that the brackets were set up as, what is that word for the 10 categories? Deciles. Thank you. Okay, thank you, Brian. Even those would change if we sort of, depending on how many folks were in the base. So we will hold that one perhaps forever, perhaps until our next meeting.
Another discussion that was had in the committee that there did seem to be a clear consensus on was adjusting the tax rate by local decisions, local education spending decisions. So that's why that's in black here. So rates would be increased or decreased by the same percentage that locally voted education spending either exceeded or was below the statewide average. And that statewide average education spending would be based on the prior year's education spending. And it would also, the assumption here is that it would still use the same definition of education spending that's under current law. And then I have included the explanation of how the General Assembly sets the current yields, the current tax rate. So the property and income yield is based on local education spending decisions. Then by the end of the fiscal year, the Commissioner of Taxes calculates that spending adjusted homestead tax rate for each town based on its local spending decisions. And then it's the General Assembly that has the authority to set and pass those yields. So under that bullet point are a couple of questions about how this new tax might be structured, how that timing would occur, if it would follow current law, if it would follow the same process. And again, whether an education tax rate would be adjusted as a lever. So whether that could be either put into statute or done through the current process where there's a notwithstanding of a default rate in statute, and whether the General Assembly wants to use that rate as a way to address any shortfalls or overperformance in the education fund.
And so it seems to me like the question here in sort of non-legal shorthand is, do we want to essentially follow the same process that we follow right now with a something like a December 1st letter, a yield setting process, like a rate setting process that involves notwithstanding, while still having something as a base in statute in case the legislature does not come to a decision, which is what we do now.
What would, because we have to not, what do we notwithstanding?
There's a rate that sort of sits in statute in case we can't get it together to make a decision.
Yeah.
$1.10, it's usually enough to make us make a decision.
Right.
It's only come up once that I know of.
Oh, it came up in the House last year.
Question. It's in black, but I'm just kind of thinking it through here. So what's the point or what problem are we solving by comparing a district's education spending per pupil to the statewide average instead of just comparing it to the yield like we do now?
Do you want to?
Sure. So I believe you're referencing this primary bullet point that says that EIT rates would be adjusted
Yeah.
by district. So this was our understanding of committee deliberations,
Yeah.
that the way rates would be adjusted for local spending would be looking at the prior year's statewide average. And then if a district decided to spend above or below that, its rates would be adjusted up or down by the same percentage that it's
Okay.
per pupil spending. That's a policy decision. And this is a little bit different than in the current year, the under current law where it's compared to the yield, and the yield is set by the legislature. This would be looking at an actual metric from the prior year
Right.
and comparing it.
All right. I just think of it from a cost containment standpoint. That would, I mean, I'm not gonna, would further disconnect the the district's decision from the impact of that decision, but.
I think our thinking on it
Yeah.
was that it would be a more transparent experience for voters because they would have more information going into their voting about how their rates might change.
Okay, yeah, no,
We know the percent.
I think you're right on that point. I just, it makes the money cheap and cheaper than it is now, but, okay.
And if I may add one more, I think that this also came up in committee, also the conversation as to should rates only be adjusted upwards or could they also be adjusted downwards? So our understanding was with the committee was that if a district decided to spend below the statewide average of the prior year, then its districts would be also below what is set within the rate structure.
Okay.
And you're saying you're okay with this moving forward?
Yeah.
Okay,
fine.
great. Okay.
Yeah. We're a ways from the finish line.
Except this is our second to last meeting, so we're a ways
No, I mean,
from
like-
the legislative,
No,
yes.
it's-
We are certainly a ways from anyone signing this, yes.
Maybe we should take this up to new member orientation and
I was thinking about inviting them all to just see, like, are you sure you want to come back in January?
They might-
You got a month, you can back out.
So the question about, yeah,
Well, could I just ask, I'm hazy on how this is different than what we do now. Because I mean, I remember us talking about it as a way to kind of replicate the current adjustment that happens. And I don't know who I'm asking, but so are we replicating it or are there implications in this approach that's a lot different from the adjustment that happens now? I guess that's, I don't know, you seem
Well, the
to.
adjustment happened, no, it's just a reference to the yield. Yeah, what you spend in relationship to the yield. That's the conversation. It's where you are in relationship to the statewide average. And so is there a yield here? Would there be a yield?
So my understanding of the decisions that the committee has made is that there would not be a yield.
Okay.
The biggest difference that I see in terms of the local adjusted rates in this proposal or this discussion as compared to current law is in current law, the local adjustment of rates is really dependent on the yield. And the yield is really dependent on all of the funding and spending coming in and out of the education fund. Whereas in this discussion, whatever we're calling this document, those rates are adjusted based on last year's education spending average. So the yield is a function of a lot of things that are all moving within the education fund, including non-property revenue sources, all local spending decisions, reversions. Whereas in this option, the adjustment of rates is only based on the prior year's education spending average and how that relates to the district. And I really see two questions here in this bullet point. One, the first one is, well, I guess three. Do we understand that that is what the committee is envisioning? Two, just in terms of structure and timing, would it follow the same structure and timing as it does under current law, where all school districts vote their budget, and then the commissioner calculates how each district's rates would be adjusted? So same structure, same timing, all of that. So that's the first question. And then the second question gets into the use of those rates as a flexible lever within the education fund. And I can talk more to that if that would be helpful.
So let me just to try to get it. So if we don't have a yield, the yield is the yields right now and the non-homestead rate are the flexible levers that we have. If we don't have any yields, does that mean the only flexible lever we have is the non-homestead rate?
Exactly. So that's one of the decision points, and that gets into that second sub question. So our understanding is that the non-homestead would be retained as a flexible lever. The committee would need to decide if the education income tax would also be a flexible lever. And the way that that would be a flexible lever would be the rates would uniformly across the state be adjusted up or down based on forecasted revenues.
Rates right here.
Yeah.
Yeah.
That's your letter.
Well, no, this is just the document we got. So these rates would be a lever.
Or some.
Whatever
rate
rates,
we
whatever
set.
rate we set in statute.
Okay.
Instead of quarreling about the yield every year, we
Quarrel about those rates.
and presume non-homestead correlation.
Okay.
Instead of raising the
Discuss.
property tax, we would be discussing how much the education income tax would
Rates
go
would
up or
be.
down.
And that really is a policy decision if those rates should be adjusted up and down. So we have really thought about the different flexible levers. So it could be the adjustment of these EIT rates, could be the adjustment of the non-homestead rate, and or it could be a stabilization reserve. So right now, the stabilization reserve in the ed fund isn't really used as a flexible lever. It could be that when revenues come in much higher than anticipated, a lot of that gets siphoned off and put in the stabilization reserve. So in future years, if there's a recession or revenues come in below forecast, those dollars could be pulled out of the stabilization reserve and used to make up the difference.
Okay.
One of the changes we're making is that the two taxes that will be going into the ed fund now are the ones that they're both vulnerable to any kind of a recession in the national economy. Whereas right now, the property tax is a little more protected.
Stable.
Well, we will still have a property tax because we're still going to have the non-homestead
Non-homestead.
tax, which is.
Over
which
60% of our property tax comes from that.
And we'll get to another decision about what we even count as a non-homestead tax in a minute. So,
Okay, so sorry.
no, that's what we're here for. Nothing to apologize
Some
for.
of us have been meeting on this agenda planning.
Yeah, I've thought through each of these bullet points longer than you have. Because I had to make sure the sentences might make sense for other people's brains, which I might not have succeeded at. So does the retaining of the December 1st letter process make sense to folks?
Yes.
Okay, great.
It will say different things, obviously.
It will say different things,
But, yeah.
yes.
And that's,
We do with that,
And that we would then go through a notwithstanding of the rates that are set in statute every year that is based on an ed fund outlook. And maybe we would pass that legislation sooner or later, depending on,
So we'll be anxiously awaiting what these rates are instead of what the yield is.
yes.
Yeah, okay.
we could also just.
Some of us don't get anxious about it the way you get anxious about it, Scott.
Could we just accept that and then true it up the following year?
Yeah,
Okay,
I mean, in the sense that we do a lot of things.
right. I was just making sure if we wanted to.
okay.
So my understanding is that this first bullet point in red, would the structure and timing be retained, or the committee is saying yes?
Yes.
Great.
I'm glad.
Great in terms of guidance, not in terms of policy.
Thank you for the clarity.
And then with respect to the second bullet point in red, has the committee reached consensus?
My understanding is that the committee, and happy to be corrected by the committee, that we're saying that the rates would be adjusted statewide as a lever to accommodate revenues being higher or lower than forecasted at sort of around the same timing that we do the yield.
Is it just revenue or is it spending?
Yeah.
That's a good, yes.
If we spend more, we have to raise more. Okay.
Yeah, so we would vote on the rates about the same time we normally vote on the yields, right?
Yeah.
And then on homestead, okay, got it.
But we wouldn't have to. Like, we
Right,
could do it
because we have
early.
this Default.
And we would also have, we're good, let's talk about the value of the reserve when we get to the reserve paragraph, even though it's going to be hard because it's tied to this. Okay.
the only question I would have on that decision point is, would you want to include a statutory requirement to consider that? And, or would you like to follow the similar or the same process that the legislature currently uses for the non-homestead, where it's a default and then it's not listed? So it's not in statute, it's always a session law, requires action by the General Assembly.
Yes.
Yeah.
The latter.
Thank you. Okay, the next bullet point is retaining the December 1st letter process, and then what's in red is just highlighting what would need to change within that section, what the assumptions would be. So this is essentially laying out what you would see in the December 1st letter. So there would be a rate that would be set at X% for that fiscal year. The statutory reserves would be maintained at whatever percent, that we might just put on hold until we get to the section about the statutory reserve in case there's a decision to increase or decrease. And then finally, there is a policy decision about what the proposed change in the average non-homestead and the education tax rate or tax liability would be. So just to take a step back, the current December 1st letter does require the percentage change in tax liability for the two property taxes to increase or decrease at the same amount. So you could choose to do that. You would need to, between the homestead and probably the education tax or not. So that is a policy decision, whether that's something you want baked into the December 1st.
So and just for anyone watching from home or anyone on the committee who doesn't know, the December 1st letter was released yesterday
On December.
on December 1st and can be found on the JFO website. So while the December 1st letter says they need to increase at the same rate, we can notwithstand and have one increase and one decrease.
Yep.
Okay.
We're not tied in statute to,
The actual.
We're not, the December 1 letter doesn't carry force of law in any way. Other than
Not at all.
required. So we don't withstand the letter. We're,
Yeah.
I'm asking that just to make sure.
That's correct.
But yeah, we would, I'm assuming we would want to continue to have a relationship where they go up or down in concert.
well, I think there's something interesting about the idea that there are times when the economy might change in a certain way where incomes might be going down, but property values might be going up, or, you know, things like that, where it might not actually make sense to have them change in the same direction.
Default would be, in terms of the letter.
Yes.
A presumption of moving together, I would have thought.
Okay.
And that's how all as the session goes on, that's how all the JFO outlooks are done, unless we tell you to do something differently as well, right?
That's correct. So whenever I'm modeling the yields and working within the yield model, I solve the yield model for the non-homestead, homestead, and income, all to be the same average bill change, so either up or down, unless I've been instructed otherwise by the legislature.
Something that just came up like an aha moment. Right now, I own non-homestead property. I pay a non-homestead property tax to support education and local. Now, I am going to pay a education income tax if I'm a resident or if I'm earning money off that non-homestead property. I'm going to pay for education based on my income, plus I'm going to pay for education based on my property. Is that going to be an issue? Are we?
So you would also.
Something we haven't talked about, but I have a feeling the people paying the tax will want to talk about it.
You'd also be paying it through sales and use tax and a percentage of the meals and rooms tax that you're paying. So there are different funding sources, but that would not be considered double taxation, for example.
Okay.
Different tax types.
And I guess I'm curious from you how that's different to you from the fact that right now you're paying a homestead tax and a non-homestead
Well,
tax.
I'm paying a homestead tax on my home, and I'm paying a property tax to pay for school. Now I'm not going to pay a property tax for schools. I'm going to pay on my income.
Yeah.
Okay. If I own a non-homestead, a business block.
Yeah.
Okay. I am paying right now I'm paying on that non-homestead property to support education. If we do this, I will be paying on my income to support education, plus I will still be paying the full, okay, but we will be removing the education portion from that non-homestead property tax, right? No.
No change.
Okay, so one individual will be paying two taxes to support education.
The same way you are now, which is the homestead and the non-homestead.
No, I think what you're saying
It's
is.
not like the renter issue, because the renters pay their income tax and they're paying property tax through their rent.
Right.
A business owner would be doing the same. They pay education tax through their income and through the value of the property of the business.
The same way a person who owns multiple properties now pays multiple taxes on those multiple properties.
Yeah, but it's all property taxes.
Yeah, sure.
Income and
Yes,
property.
yeah.
I think the point you're trying to make is that right now on that rental property, you're not paying any taxes to the education fund on the net income that property generates.
Yeah,
Thank you.
I think,
Right, so for me as a homestead owner, you're taking away my school property tax, which is usually 2/3 of the tax. And you're gonna hit me with an income tax. On my extra 5 acres, you're going to continue to tax me. But if I own businesses, right now I am paying we're not taking the ed tax away from the business like we are from the homestead, but we are taxing the revenue, the income of that owner, the property makes from that business.
Would the property tax, the non-homestead property tax, be able to be written against profits on that non-homestead though?
you expense it.
So you're expensing that
You
tax
absolutely expense
already?
You would expense it.
Yep.
Are you wondering about, say, if a business owner doesn't own a homestead, is that part of the question?
No, it's just that we've talked about the homestead, and for the homestead, there's a switch. We're going from property to income. For a non-homestead owner, and we tend to be talking about $1 million condos, but there's a lot of downtown business properties that we are not removing the local education tax from, plus we're going to tax the individual owner's income to pay for education.
Well, yeah, I see what you're saying, but only, right, but they're only, so you're,
Very similar to the renters, the way I think of it.
Yeah, I mean, it's,
Well, except the renters can't write off their, I mean, we're creating a situation where they can write off their rent and non-homestead owners can write off their taxes towards their income. I'm going to ask us to hold this
yeah.
I don't-
conversation
This is
until we
one
get,
of those
there's no
questions
decision
that
point, yes. And I think,
will come up.
and I think we're going to have,
Works its way through.
and when we're actually going to talk about the definition of non-homestead a little bit, so we can talk about that again there.
So before moving on, just to clarify the decision points from the December 1st letter, these sub-bullet points, it sounds as though, or this third decision point, would the percentage changes to the average non-homestead and EIT rate or tax liability be required to be equal? Are you
Yes.
saying yes? Okay. And holding off for the earlier two bullet points there? Okay.
Okay, so what you were essentially going to be saying is if you spend $1,000 a student more than last year's statewide average, your income tax in this town will go up X percent or 0.1%. But so that the reason we do all this is so that, at least in theory, if people know what it's going to cost them, they'd be maybe more inclined to not vote for increases, but.
or see it transparently.
Or, yeah, I mean, but it's generally been used hopefully as a cost control. We've tried all kinds of ways and haven't succeeded yet. Okay.
Okay.
The next two bullet points were looking at current statute and what is required in the December 1st letter. There is a default in this section that relates to the non-homestead. So I just made a note there that having a default, you might just wish to repeal this subsection altogether because you would essentially have a default already in a different section. But again, that goes back to the previous discussion about whether you would want to adjust it. And that was clear that that's a decision you would like to make. For subsection C, it would just be a sort of a technical conforming change to make sure that it's referring to the education tax instead of the non-homestead tax. So no real questions there. The last bullet point is something that has been brought up. It is one of the charges of the study committee, which is to consider putting a cap on AGI. This was brought up in a few meetings, and the sort of the reason this is in red is whether or not the committee is ready to make a decision or whether you would like to have the report state that there is no recommendation, but we could provide sort of pros and cons, advantages and disadvantages. Notably, if you are putting a cap on income subject to the new education tax, that would require another lever for making up that revenue, assuming that you want to keep the amount of revenue raised the same.
And likely that lever would be that all the rates would go up on middle income renters. Yes, like that's, I think Graham talked about a balloon or a pillow or a bubble or something. Just like imagine smushing.
Okay. I'm just, because we're talking about percentages. Okay. Am I calculating this correctly? Because we're dealing with decimal points, which isn't my strong suit. my income is $1 million, am I going to be paying $265,000 in?
They're marginal rates.
No. Move the decimal over one. 26,500.
And we're not setting, I
There
mean,
we go.
I think we've all agreed that none of these rates are final at all or even close to final.
So we're,
Yes,
Very significant.
yes. They're both marginal rates and your decimal's in the wrong spot.
thank you, I figured it was.
So do folks want, I'm going to ask you actually if you just want to have a conversation about the cap. And if you do want to have a conversation about the cap, I actually want to hold that conversation about the cap to this afternoon. Because I think it's helpful to look at Jake's modeling before we even have that conversation about the cap.
Sure.
So do folks want to talk about the cap this afternoon?
I'm also okay with the report saying the committee did not come to a decision on the cap and make that part of the legislative process.
Okay.
I mean, I think that's where I'm going to end up too. But if there's some modeling to it,
Okay.
I'd be willing to look at it.
Okay, great. Onwards to administrative considerations.
So this is a nice fun bullet point section here that gets a little into the weeds of how this new tax would apply, how it would be administered, how it would be collected. The first question is, would the personal income tax administrative provisions apply? That does create a whole known structure in terms of standing up a new tax. That would likely be the fastest, most efficient, and the easiest for taxpayers to understand. So a few of the questions that are laid out here are also about penalties and interest, those sort of things that taxpayers feel directly, as well as there is another section on transition, but what the study committee might want to recommend in terms of implementing a new tax and what would create any sort of penalty or interest requirement. So in this outline, there are some current sections of statute cited for the personal income tax that lay out a safe harbor that is for estimated payments, as well as how overpayments or refunds would be treated. So I don't know if you want to get into the weeds of those or if you want these as sort of flagged questions in the report for legislators to think about.
I think there is like a wild throttling noise happening, right?
Yeah.
There's some sort of
Okay.
HVAC here.
Great.
No,
More.
they're doing we're foundation hammering.
I just want to thank you
My
for
committee
helping me
rule
through
is
acknowledging that.
plywood it up
Yeah.
again.
I think the big question is, do we essentially want to have this follow the same set of statute and rules that the income tax follows in terms of penalties, in terms of estimated payments, in terms of overpayment, underpayment, all of that?
And filing as well.
Filing.
That is,
Yes.
because.
I can't imagine why we wouldn't.
Okay,
At least as a starting point.
yes.
Yeah, that's the question. Is there a grace, while we work out the kinks for a couple of years?
Yeah.
Something like that
My temptation,
doesn't remove the liability, but maybe the penalties as that's the question to me.
my temptation is to say, yes, it completely lines up, and there's a few years of grace period around penalties specifically, but that all of the other statute is the same. One piece I'm going to flag related to all of this is we had a conversation about escrow at our last meeting. And right now, if property taxes aren't paid, there is, priority for those property taxes to be paid out of a tax sale, basically. But if income taxes aren't paid, there isn't priority on a on a property, on a lien for those income taxes. While like bankruptcy sales could be related to all of that, it's not, they don't have priority over the bank's ownership of that property, which might be fine. I just want to flag it out loud because it's something that we talked about. So this would sort of remove any, if we maintained this, if we lined up with income taxes, there would be no need to escrow income taxes is essentially likely.
Right, you would withhold them, right?
Yeah. We would withhold, but it wouldn't be an escrowed withholding, the same way we escrow property taxes. And like, that's more, we can get more in the weeds. I just want to sort of flag that as one place that
Yeah.
lining up has impact.
Right. I mean, I think the state could put EIT at the first part of the line. They could.
Yes, but that wouldn't, if we follow this, that wouldn't be what happened.
Yeah.
And it would affect mortgages.
Would or wouldn't.
It would not. That's the
Put
thing.
it in the, if we put it. in the
Yes,
front.
if we put it in the front, it
Right
would.
now, it's not.
Yes.
It's behind the banks. If we put it in front of the banks,
Or you know, the property taxes in front is behind the
Banks will love that.
The banks are listening.
Well,
They don't like anything in front of
Well, put it in the same place it is now.
yeah.
Sorry, Chris.
You picked the right
Okay.
day to go.
So right now, I hear people saying sticking to the current administration and liabilities of the income tax, and then we'll talk about transition, like what, withholding.
We're all comfortable with
Yeah.
2-year
Great, okay.
holiday or something.
And we have a transition section that we're gonna have to hit anyway, so, okay.
There is also the question about filers, and there is a population that is not under current personal income tax law required to file. Would the committee recommend following those same thresholds, or would there be a
Yes.
different requirement?
Well, it's a pretty low threshold if I remember right. Less than 500.
So currently, residents, part-year residents, and non-residents who earn Vermont income and who are required to file a federal return and who have at least $100 in Vermont income, or if they're a non-resident, $1,000. Those are so it's quite low. I'm sorry, I do not know off the top of my head what the federal requirements are. It is by filing status. I think it's about $10,000 is my recollection, but I think it's also adjusted by, it has an inflator. So these are lower income folks. Would you want to follow these same rules, or would they be subject to different filing requirements specific to this tax?
Strikes me as an unnecessary penalty on the poor in terms of administration, and we already have folks who would benefit from filing who aren't filing and still don't file. It seems like we'd be creating a trap for people
If we said they had to file,
if we expanded the filing.
when we say they have to file, that means we're saying they're subject to the tax, or those separate?
It's saying that yes, and they're also subject to penalties for not filing.
Already be subject, I think.
Yeah.
Impact is,
Yes,
but we're talking about $30, right?
Yeah.
$30. So my principle would be to change as little as possible. That would adhere to this for me, but.
Does somebody in order to get renter rebate, do they need to file?
Yes, I think that question was answered.
Capture a lot of that.
We do.
Okay,
Yeah.
all right,
okay.
Take their EITC and any of that.
okay,
It's-
all right.
So I think, yes, we're following current law, yeah.
Also on the question of forms and filing, would be different declarations. There is currently the homestead declaration, which is on the same form. It's two separate forms, but filers get both the homestead declaration and the property tax credit. Would any sort of homestead declaration still be required, given that there would not be a property tax on the homestead? Or would it just be the personal income tax form, which also raises the question of renters? So you have those two population, homeowners and renters, and how are they not paying the homestead tax? And when do they declare for purposes of the new education tax on income?
My previous memory of these conversations, which is mostly quoting you, Senator Pearson, so if you'd like to speak for yourself, feel free.
I'm excited to hear what you.
We would add some check boxes to the new income form, which would include checking that you have a homestead, and then checking that you are a renter and that you paid X amount of rent this year. You would not check both boxes. You would check one box or the other.
Well.
Or neither.
If you rented half a year. And
Yeah, then you would check both,
So,
yes.
so I don't know that we need a renter checkbox, but you need a line that says I paid.
Mm-hmm.
Well, yeah, no, you would need to understand that it was where you live.
Yes.
So because if I paid my kids rent for them, it doesn't qualify.
And so before we go deep into renter, so we need people to declare that they have a homestead in order to basically say whether they're liable for this tax or whether they are responsible for the non-homestead tax.
Is that true? Because we're not, everybody's liable if they're filing income.
Yes. But in order for a property to not be,
Subject to
Property, we have to deal with the property. We have to.
property itself has to be declared
Yeah,
a homestead. And so that could happen on that same form.
Form?
Why not? Why do we make extra forms?
I don't know. It's a good question.
They are currently required at the same time.
Okay.
So homeowners are filing their personal income tax forms and a homestead declaration.
But even if,
check the box, put the span number in there.
even if you're not filing a household income declaration, you're saying, this house is my home.
Yes.
Okay,
They're two
so
separate.
so we do need that. We probably do need the household income for the circuit breaker, right? For the municipal.
We will get there.
Another
Okay,
Patience.
But you're correct. There's a lot of
I'll
information.
entirely get rid of it. Okay.
Okay. So check boxes, same form.
There is a note here about some of the information that previously was reported on the income form right around the time of Act 60, when that actually took effect and was implemented, that was removed from the income tax form. But previously, taxpayers were just required to disclose the amount of property taxes that were assessed by a municipality on their house site. Just a little bit of history there. So there is some precedent for having different taxes and different information on the income tax form. The next section is also, so that I just want to pause and see if there were any other questions or concerns about that administrative side.
Okay, did we do the how would taxpayers who do not file dealt with?
My understanding is it would start as the same requirements for the personal income tax form. So those who.
So if I don't need to file a personal income tax, those 70,000 people would not need, I think that was, we had 70,000 that didn't file. They would not have to file, thus they would not have to pay under this.
If you were following the same requirements as personal income tax, yes.
If they own a home, their home, if they're not filing, their home will default to a non-homestead rate.
Yes.
If they own it, which is.
Yeah, I think we heard that some of them paid based on their home value because it was lower than their income.
Right, which is.
No, that wouldn't be someone whose home value is lower than their income would have an income that was high enough that they would be having to file an income tax. If,
You're talking about their home tax liability is less than their income tax.
yes, but that's not someone who wouldn't be filing an income tax
No.
That,
in current law.
It'd be
that's,
potentially fraudulently not filing, but they're.
well, there's people that are paying the non-homestead because it's lower, even though that's illegal, but.
But you are correct. If you're saying the declaration of a homestead is on the personal income tax form and an individual is not filing, then if they are a homeowner, they will be paying the non-homestead.
Okay.
It's one way to look at it, that it's all property, it's non-homestead until somebody declares it as homestead.
Right. That's a useful, that's actually what current statute says.
Okay. So I think we agree on that section. And we're going to spend more time on the renters later. Never fear, the renter topic never ends.
So exciting.
I think we're on withholding now, yes?
Yes. So still within the realm of how our individuals paying this new tax, there would be withholding and estimated payments and then an annual filing requirement to reconcile tax owed and tax paid. So I provided a little blurb on how current personal income tax withholding works to give you a bit of a background. It's generally required on certain types of income, wage income, some pensions, annuities, and other payments, if those payments are subject to federal income tax withholding. And those payments also, to be subject to Vermont withholding, must be made to a Vermont resident or a non-resident of Vermont performing services in Vermont. So that's where I'm sure you've heard of the discussion around remote workers working here. They are now subject to withholding if they're working and performing services that they're receiving compensation for in Vermont. Vermont does follow the same withholding calculations as down at the federal level. So those are either withholding tables or wage bracket charts. And I use the example of an employee just because it's the most simple. If the taxpayer provides, often when an individual is hired, they provide the federal W-4, both the Vermont W-4 and a federal W-4 to their employer, then the employer withholds whatever the employee has told them they owe. There is no requirement to provide the W-4 directly to the Department of Taxes. It's purely so that the taxpayer is meeting their liability to pay tax, but also the employer has a liability to withhold. So that's pretty much the rest of that.
And again, this is like this section isn't things that we have made up. This is how current law operates.
Set it up so you can think about how these payments are flowing through. And then when an individual files their Vermont income tax return, they state this is how much on their W-2, they have this so much my employer withheld. And then you have that credited towards the payment that's actually due. And that's where you go through your calculation of how much your deductions and your adjustments and then any credits, and either you get a refund or you owe taxes. So in that framework, looking at taking that personal income tax structure, Julie and I got a little creative, and these are not really policy recommendations, just ways to, get into the meat of how would you actually do this for a new tax, especially one that would be a little more complex and has different timing than personal income tax, and looks at different taxable years. So I might let Julie, do you want to?
Sure. Are we about to talk about taxable years and school budget years? Because if we are, I want to be clear, we have a whiteboard right there. And I find it almost impossible to track the difference between a calendar year, a tax year, and a school budget year without seeing all of those years line up on a whiteboard. And I know I'm not the only one. I don't know if we have whiteboard markers. I'm sorry, Sorsha.
Leave the room momentarily to get the markers.
Okay.
I gambled we wouldn't use it and it was not working.
Sorry.
There's one marker right there.
That's not a whiteboard marker.
It'll work, but you won't get it off.
It looks like.
I'll get a.
Thank you.
Yeah, we're probably going to need 3 colors at least.
Should I?
You can start talking. I just want to I'm relieving my own anxiety about the different years by talking about the whiteboard. You can.
All those in favor of letting the co-chair use the whiteboard?
I think you mean Anne, right?
Do you want us to move the whiteboard so it's?
So we can see.
I know I'm not the only one that struggles with lining up these days.
The visual will be helpful.
You can get to the federal tax year and the state tax.
Oh my God. Okay.
To
Okay.
be fair, when Abby and I were trying to sort through all of this and work our way through, I also had years written out in front of me with arrows. So
Yeah.
we're all there.
There are too many years.
Thank you, Sarsha.
So Abby and I really sat down and tried to think through how this would work, given the new or different complexities, as compared to what we have currently.
Well, you don't have to do that part. You can just put the markers down.
All right.
Thanks.
Let me know when you need me. Okay.
So big picture, before we dive into years too much, we're thinking that it makes, or when thinking about how it would make sense, it might make sense for a taxpayer to choose to withhold from their wages a tranche. So 0%, 75%, 100%, you policymakers would decide what those would
Of the
be.
liability.
Of the prior year statewide average mean rate. So the tax liability could be reconciled in April.
Average mean, that would be my personal income tax that I owe plus the school income tax, or just the school income tax?
So what we're thinking about right here is really only talking about the education income tax, and how that would line up with personal income tax. I see as sort of being a second or a later question. It certainly is a valid question, but right now it's thinking about how would the education income tax withholding work. So that's sort of big picture, what we're trying to figure out how that would work. That's the framing of the question.
I'm realizing that in that framing of the question, I am assuming that in that question, that the taxpayer would actually have a choice between 75%, 100%, and 125%, or whatever those are. But the taxpayer would have a choice between sort of under withholding, over withholding, and exact withholding. But maybe that's not, maybe that was.
That was our understanding
Okay,
based
great.
on the previous committee's conversations. We tried to take sort of how far we had seen the committee got and then think through what would be the next set of questions.
Great.
So,
Okay.
I just would add, I think that rationale also sort of comes over from the personal income tax
Yes.
as well, where you can tell your employer how much you want to withhold based on your projected income, your family situation, all of those variables, as well as having an option for zero if the taxpayer anticipates either the tax rate not changing or having far less income. There needs to be that option.
Okay.
Yeah, or if they're a renter in this case, they might elect to have zero, because we're assuming.
We'll get to that.
Yeah, okay.
yeah, so right now we're talking about taxpayers. So who's paying the tax? And the question of who's paying the tax is certainly important, but we can walk through that in the next section or in a future section. But so the first question with sort of that stage being set is when a taxpayer goes to determine what percentage of their wages are going to be withheld for that statewide average mean rate, what is the average, the statewide average mean rate? It could be the school district's average rate. It could be the overall statewide rate based on population. It could be the town rate. So we're thinking about how are we going to be calculating that statewide average rate? How is it going to be weighted? Are we going to look at all of the different school districts rates and average them together? Are we going to look at all of the town rates, which is a step past school districts, and average them together? Or are we going to look at the entire statewide population and average those together?
And right now, when you calculate the average rate, which you do regularly, what do you do? Like on the Ed Fund Outlook or the December 1st letter?
That's weighted by state population.
Okay.
So you're using a weighted average then?
Correct.
Okay.
So we have, for instance, we just finished up doing the December 1 letter, building the yield model. We've got all the different towns. We've got the households within each town. So we know that there's X number of households in Montpelier. This is Montpelier's rate. And then we weight it that way.
I also just interject, in terms of all of these rates that you're imagining, how would a taxpayer decide? How would they know? And how would that actually hit their paycheck if it's an employee? That would be following the same process where the Commissioner of Taxes is creating withholding tables. So all of these would be plugged in, and then the employer, probably using a payroll company, would just take those rates. Those are published annually.
What is the lag for those? Do you know? I mean, I can ask for those being published.
I don't know that I think it's published around this time each year, but we can ask Jake.
Okay, great.
Feldman when he comes in. I think he does, is obviously part of that.
Okay.
So that's one question. I don't know if the committee wants to discuss that question or if you want me to sort of go through keep going.
Do people have a preference on sticking with the average rate, the way it's calculated now versus moving to a different way of figuring out the average rate?
Is there much difference between average and a weighted average? I mean,
I would say yes.
yeah,
Because if you think about a very small school district versus a very large school district, it's the same as thinking about, I find it helpful to think about like I'm going a little off rails, but the federal government, and you've got the Senate and the House, or here in Vermont, you've got the Senate and the House. And so different size districts carry a lot more weight than they do.
but that doesn't necessarily correlate to spending. I mean, you can have large districts that are.
I don't think that's true in Vermont. I mean, I guess I think that here, I'm sorry I interrupted you, but I think that we have a number of districts that are quite large that tend to be on our higher per pupil.
What's the
And that are about to be much lower per pupil.
right, the weighting? What is the range of, you know, how big a deviation are we talking about? Do we have any sense of that?
In terms of,
Well, if we said, the way I think of this is it could be sort of easy at the withholding point, easy for the employer, or be closer to precise, right? And so if we just did, let's say, the state average, I'm wondering what is the deviation? What is the range of the deviation for people? In other words, that's going to take care of the person that lives in an average spending district, but it could be a rude interruption for somebody in April if they actually live in a high spending town. And so that's what I'm wondering.
yeah, so.
How rude?
I don't know. I would have to look into it to be able to give you some numbers. I would say that when thinking about this option, we were sort of running based on, it may have been last meeting, but the conversation that it wouldn't be, that employers would be withholding based on different rates for each of their employees.
You were assuming that, or
We were assuming that the withholding would be based on an average rate.
Yeah.
And the employers would look at that average rate, and that's what they would be using for withholding. And then in theory, the employees, if they know that they're in a low spending district, could withhold less than that average. And if they were in a high spending district, then they could withhold more than that average.
And I hear Chris's question, or maybe my question based on what you said, is using the district average versus the statewide average. Would the average of the districts be more likely to sort of lower the range, essentially, of the taxpayer's experience when they're reconciling?
I mean, right now, there's no withholding. You write a really big check for your property tax.
Yep.
And it's up to you I had one lady that put a quarter in a bucket every time she did a load of wash. And that was her property.
Kind of like that idea.
Could just do escrow.
Well,
Most people do it.
Yeah, it was her escrow.
no, I mean, I think what you're outlining makes sense, but I'd love to understand if how expensive the reconciliation. I mean, that's what we're talking about. We're either going to get a big check back or you're going to have a liability in April. And so is that potentially a fourth? I mean, there's a lot of variables, but.
Julia, can you are you able to answer my question? Or should I?
Can you rephrase
Yeah.
the question?
So I want to find whatever definition of average would create the lowest amount of variability between a taxpayer's reconciled liability and what the average is. And so whatever sort of tightens the range, is sort of the best for tightening that range is the average I would want to use. And I don't know if you have a way of figuring out which of those two averages would tighten that range the most.
I can certainly look into it.
Okay.
I don't want to testify to it until I've looked at it.
Okay, cool. Okay, thanks. I think Andy was next on this.
Oh, okay, sorry.
I just wondered why we wouldn't do the district. It seemed like the district would be the way to make that liability closer to the reality, because it's just that one district, unless that district decides to do something with their spending. Is it more complicated? Would it be more difficult to do? Is that a reason not to do that?
Yeah, I think that's a great question. It comes down to the structure of how this would work. My understanding is that there would be one average rate across the entire state. So when talking about this first bullet point in terms of what rate should be used, the bullet point is really talking about how would that average rate be calculated across the entire state. So would you be averaging by district where different districts would all have the same weight, so to speak, regardless of size? Or would you be averaging based on how many folks live in each district?
Well, I guess the crux of my question is, do we need a statewide average for this? Like, why not just use the rate of the district? Because each district would have a rate.
So that's a policy decision that would become more complex for the employers. It's also important to note that towns are in 1, 2, or 3 districts. So when we're calculating town rates, we're prorating those town rates based on what percentage of pupils of that town attend the different districts. So
I think we want to minimize how complicated the tax tables are, basically.
Okay, that's the answer to the question.
And as I'm listening to this, I think we also want to peg to the higher number. Because people are just going to be happier getting a refund.
So I think, Julia, you're going to get back to us with a little bit of information about that question.
yeah,
Okay. And then I wonder if we could talk about which year we're talking about when we talk about years as our next thing, because we have 15 more minutes on this topic, and I would love to make a decision on at least that part.
okay, sure.
It's going to take 15 minutes just to do your graph.
No way.
No, it's just 4 years. They just need a little line.
I think that the year question really gets down as we go into a few more bullets.
Oh, okay,
down.
sorry.
That's when we're really getting into the years.
Okay.
Fun. So we could skip over the rest of this question or finish this up.
Let's finish this up, please.
Okay. So then the second part of this question, and I'll get back to you about how the differences in weighting of the rates, but the second part of this question is how would the prior year rate be adjusted? Because we see, for instance, this year, education spending is forecasted to grow by over 8%, I believe. So as education spending per equalized pupil increases historically, would you want to adjust the rate to, as you're saying, you want people to be more likely to get refunds? How would you?
In the tax table. You mean the rates that are in the tax table that are used for withholding?
Yes.
I would imagine it would be based on the effective tax rate, which we have decided in statute the previous year.
So that's one option that we had. And then the other option would be, would you want to adjust that prior year's rate based on the forecasted annual change of ed spending per equalized pupil? So if ed spending per equalized pupil is forecasted to increase by whatever percentage, do you want to adjust the prior year's rate also upwards?
I guess the question would be, who is you? Because we don't come in till, when we're here, we wouldn't have enough time to make any changes that could be adopted by the software and payroll people.
I think this is where I get to the calendars, is that, so
Yeah.
I feel like this question is the last step in this process of saying, what year are we actually talking about taxing based on? And how does that information get to taxpayers?
Okay.
But maybe I'm misunderstanding this question.
No, I think that's
Okay.
So do you want to get into the conversation of years now?
I think we should, yeah.
Okay,
It's the big one.
so I'm skipping over this mandatory homeowners, not for renters bullet point right now, so we can just continue in this line of thinking about timeline. So I'm at this bullet point, 2 different EIT rates will likely apply during the taxable year.
Yeah.
Do you want me to jump in? Okay, just as a lot of these are my words, so I feel bad making Julia. It's always hard to read somebody else's words. So the way that we sort of butted our heads up against this issue is that there are 2 different taxable years at play here, 2 different fiscal years as well. So the tax base you're looking at is adjusted gross income. So you're looking at an income tax taxable year, which follows, the calendar year, January to December. However, this is, the education tax will be looking at education spending, which is following the school year. That fiscal year is July 1st to June 1st. So you're suddenly split between 2 different taxable years. And that would also mean 2 different tax rates. So you would have your period finishing up the second half of the education tax fiscal year from from January to June. Maybe I should start writing. And then this new taxable year, starting in July, going through December. How would you address these 2 different tax rates applying to an income base in one taxable year?
And then there would be overpayments, underpayments. Do we just carry forward?
Let's hold that part.
Okay.
Yes, so that's the
Another-
conundrum and the puzzle of how do you reconcile come the following April?
Not till the following April.
And you have 2 different tax rates that you'll have been withholding. How would you withhold as you're earning income? What will be the tax rate that you're going to reconcile with in April?
So the way there's a school budget that's voted on sometime between March and June that I'm going to use years so that my brain doesn't break. So in 2020, in March or April of 2020, you vote on a school budget, which applies to July of that 2020. You are paying taxes for all of January through December of 2020, and then you pay those taxes sometime between January and April of 2021. It seems to me that rather than splitting a tax rate across 2 years, splitting a tax rate across 2 tax years, 2 school rates across 2 tax years, it would make sense to have the tax rate that applies to the latter half of the school year the earlier half of the school year apply to that next tax year so that you have a uniform rate in a single tax year.
You're saying you sort of average it out.
Don't average it out. You carry the old rate into the next year and then the next rate. So you're always on basically a half-year delay in the tax year that you are
The school
holding
tax.
your half-year school rate on the tax.
Is that what, we used to adjust the income rates quite a bit, I feel like, right? Before we were linked to the feds. Am I,
That's an income tax thing, I think. Yeah.
well, but it's a similar, with the state fiscal year and the federal,
They coincide.
they don't.
Oh, no, the
So
tax years coincide.
Yeah, the budget.
I guess I'm looking for examples. I had understood us to make tweaks to the income rates with some,
And we always delay that by a year.
that's what.
Yes.
Delay that till January.
Yeah, and sometimes we delay things 2 years. Yeah.
But even though that, we're doing that based on a state fiscal year that starts in July, which is the same kind of dynamic. So I'm looking for those lessons, I guess. And you're saying that's what you're describing is what we have historically done.
I think historically done is a stretch, but I hear what you're saying. Yes. Yeah, I think adding that sort of 6-month delay in experiencing that rate would reduce confusion enough that that separation from the decision would be worth it. I don't even know if anyone understands what I described, though.
Well, it's here.
Yeah, I think this
Struggling.
potential
Yes.
option 2 is what you described.
Yes.
I think that's the way we should go. But I say that not knowing the size of the stabilization reserve that would need to change. So I think this is the easier way to do it and just the better way of doing it. But if the stabilization reserve needs to be increased by some crazy number, that might change my opinion. Or how many years we take to get there. But that seems like the way I would want to do it.
Why wouldn't it just be easier to say the vote by the school
That's a
district?
therapy dog.
The vote by the school district applies to the tax year that the vote occurred in.
Because you don't, I'm sorry.
So if,
You vote in April,
yeah,
you withhold during that entire year, and then
What do you
you
do?
actually pay the tax in the next, when you file in March of the next.
But you already withheld in February.
January.
You're withholding for.
You would have withheld anyhow. You're gonna withhold in January and February regardless of when you vote.
But it changes in April after the vote.
I mean, a taxpayer can change their withholding whenever they want to change their withholding. They're not tied to a calendar year, tax year, or school budget year.
Presumably the rates would change in July under what you're saying, right? Law would change in July.
The withholding might change.
So that was part of our trying to grapple with this was would withholding be required? Would everyone be required to update their withholding? Would there be 2 points in time or would there be some sort of mid-year change to adjust to if someone's tax rate went up significantly and they've been withholding based on maybe 150% of the prior year, but even that's not enough. I think it was trying to get at what is a more accurate representation of their tax liability.
I think that is more transparent and could make sense. The fact that someone's sort of withholding for a rate that hasn't been set yet makes me feel a little bit uncomfortable. And then I sort of also remember that district spending might change. They very rarely does a district go from below state average to above state average. I mean, districts tend to like hang out in the same part of the graph, town by town, as each, as themselves, which again is, I think, further evidence that this is based on culture. But so I think there is sort of I think it would be less disruptive than Scott, I think your suggestion would be less disruptive than it feels off the cuff to me.
I just wonder about the disconnect, because that'd be a big change, because right now, we vote on a tax rate and it applies to what you earned in the previous year. And now we would be passing a tax rate that would apply to the future following year. Does that start to I don't know.
So as you're all talking, there has to be one change in a year. Whether it's January or July, something's changing. And there's an elegance to voting in March, April, May legislature acting, and that change being July 1, because that's what you just made a decision on.
Yeah.
I mean, in a few years, this will be trivial, right? It's really, and
I don't actually think it, I mean, it will get normal, but
it's just that your paycheck, even if you kept holding 100%, the amount is going to change in July under what you're suggesting. But you don't, the taxpayer and the business doesn't necessarily have to do anything other than they're going to get a new table from tax, right?
I think under any of these, the withholding changes in July because of the withholdings tied to the statewide average of the previous year, right?
Well,
So
the difference is we're doing withholding right now. It doesn't, you get a property tax bill and it's based on what your school budget was voted in March. You get it in July and you pay it once, twice, 4 times a year, depending on your town. And sometimes you pay 2 of them because your house is in one town and your land rides over into another town. But now we're talking about withholding. Withholding is based on making sure that you've got the money to pay your income tax. We never made sure you had to have the money to pay your property.
well, we do actually, and we actually live with a model of that. That's actually a really good point. So I pay escrow based on what the previous year was, and sometimes I get a check back to reconcile that.
right.
Really?
Yeah, I get a bigger bill is what happens.
Do you want to move to Brattleboro?
Yeah.
The withholding changes on what happened the previous year. I just wonder, how do you explain that at a school board meeting?
Yeah.
You'll basically be telling voters, you're about to vote on a rate but your tax bill won't be determined until that rate is applied to next year's.
Yeah, you'll start paying that in January. You would just say, you're voting on a rate that you will start paying in January.
And what's the advantage of that compared to having it go into effect in July, which just clearly more straightforward mirrors the bill in that sense?
In that you're not withholding based on an incorrect amount. You're withholding based on information that you already have.
And I think also the advantage is you're already thinking of your income tax on a calendar year. And so we would keep that.
It's 11:30. Maybe we could just sit with this question, each of us, and come back to it.
Okay.
Okay. Do you
I
want
didn't
to?
understand what you described as an advantage. I'm happy to sit on it, but I would love to.
Yeah, so I think that if you are withholding, I think the idea that, I think withholding will always be thought of as a January to December phenomenon, no matter what we do. If it's for a system.
Phenomenon.
It's a paycheck phenomenon, but it gets reconciled at tax time, right? And so it's going to follow a regular tax year. I think the idea that withholding is withholding towards a known amount, a known rate, is important. And if the tax rate is sort of created in the year you're already withholding in, I think that creates some instability.
Because we'll know the legislature has to act after the town vote to know what the tax is.
Yeah, but I think, and I want to understand more of what it would mean to tax, because it just got real complicated to rectify if we're doing it midway through. But in terms of the sticker shock and stuff, that already happens, right? We already vote.
Yeah.
I vote yes, I hope it goes well. The legislature acts, and then I get a bill that I'm not really able to predict in July, and I pay it in August if I want to pay it quarterly. So we're already sort of, I think a lot of taxpayers are already braced for some shift that is a little bit hard to predict. Mm-hmm. You haven't You know what I mean? It's not like you go and get a second job because you're anticipating your property tax. I think there's already some instability or uncertainty. Anyway.
So I hear everyone tending towards the sort of current year idea, other than me, and I'm happy to release myself from my own idea. If everyone else is sort of in this current year idea, I'm not that attached to it.
No, I like the calendar year.
Darn it. Okay. So we're going to wait until after a conversation with Jake, and I'm ready to like pivot a little bit. I don't know if everyone else is. We've been deep in the weeds here.
It was fruitful.
It does feel fruitful.
I don't feel like we took full advantage of the whiteboard, although Julie did.
I know we didn't actually. I
We
think we
only
could have
have
taken
one
better.
color on
I
it.
think we could have done much better on the whiteboard. Jake, would you like to join us to tell us about the work you've done? Thank you.
Hi.
Hi. Hello.
We may need that therapy dog in here.
So just want to remind folks that, so JFO did the best they possibly could with, to basically match up to disparate data sets, to model a lot of results. And Jake was able to actually match up those data sets instead of, and now has some results to share with us. Is that an appropriate summary of your?
Yeah.
Okay, great. So floor is yours.
Okay. Jake Feldman, Tax Department. Representative Kornheiser is totally accurate. The question to me was under your option 2 that you're considering, how much of the tax would be paid by basically like new filer groups, residents who aren't part of a homestead, so mostly renters, and also non-residents. So that was my work. And we did it for tax year in 2019, which is kind of a more normal tax year. The last couple have been weird with capital gains and some other stuff going on. And basically I just matched it over to the homestead declarations. And I flagged any income tax filer who filed a homestead declaration, or if they showed up as like a secondary person on a homestead declaration, or if there was a household income form where a variety of people are listed as living in the household, then I looked for that too. So to the best of my ability, I tried to flag everybody who is connected to a homestead declaration. Option 2 is the brackets are under that second bullet, which I hope I wasn't listening this morning, but I hope that that's still the right numbers to use.
We don't, we're very clear that those numbers aren't final because we haven't made decisions about how we might want to exempt different classes of renters.
Okay.
And so likely if we change the base to exempt certain categories of renters, some of those rates would need to go up a little bit, but it's the best we have for this conversation. So it was a good choice to use.
Okay. So Graham at JFO ran these numbers on his tax microsimulation model, and he raised enough money to basically replace the homestead part of the education fund. And the good news is that when I did it with my data set, I got like nearly the same amount of money. So that's, always a good thing.
That's really cool. And we're all laughing, but like those were different data sets and it's pretty cool that they lined up.
Yeah.
Yeah, like that was a very much more simulated data set than your data set.
Yeah. If they hadn't, it would have made my yesterday even more awful than it was writing the December 1st letter. Luckily they did. So let's see. And then I think this is still consistent. The third bullet is you compare the town per pupil spending to the statewide average, and then that's like a proration factor. And importantly, non-residents don't have any proration factor. It's like 1, no up or down. And then I think you're all aware that for a non-resident, you can't tax their non-Vermont income. Right. So that's something that comes through called an apportionment factor. So I applied that to the tax. Otherwise you'd get some crazy numbers and it really would not have worked out. So that's consistent with what Graham is doing. Just for your information, these aren't big effects, but I wanted to flag that included in AGI are two things that states can't tax, US bond income and railroad retirement. I don't know how much these are, but if you did work more on a proposal like this, you'd have to take that into consideration at some point.
My memory of a very long conversation about railroad income last session was that's a fairly small amount of money.
Yeah.
Probably.
Okay,
The other one might be bigger, but I don't know how much.
Yeah, okay.
There's also something else that's in AGI. It's basically for people who itemize their deductions. You probably know there's a state and local income tax deduction. If you accidentally put too much when you itemize, you have to add it back the following year. Vermont doesn't tax that. And no, I'm not aware of any state that does because it's not relevant to our taxable income at all. So that is included in AGI, but that's another thing that you'd probably want to back out. But I didn't do it. I didn't back out any of those things. I just ran it as it was. So the fifth bullet down in bold is, I think, the main thing you're looking for. So it generated the right amount of revenue. I got 472, Graham got 465 or something like that, 468. And I'm seeing that 437 of that, which is 93%, is coming from residents. And 35 million or 7% is coming from non-residents. That's about consistent with the regular income taxes. Of the part that comes from residents, 311 million or 71% is coming from filers that I could link to a homestead. And 126 million or 29% is coming from other resident tax filers.
So I would, if I wanted to sort of get from tax filers who don't have homestead, if I wanted to get to residents who don't have homesteads, I'd subtract that 35 from the 126.
Residents who don't have a homestead would be the 126. The 35 is.
The 126 is residents.
Yeah, it's residents who are not connected to a homestead.
Okay.
That number's probably a little.
Because you don't say residents, you just say filers.
Right.
Oh, sorry. It should say resident filers.
Okay.
That's good. Correction.
Because it's a subset of the 93.
Okay.
So that cohort is mostly renters, but it could be some other things. It could be basically people who are part of a homestead, but I wasn't able to link them. It could be married filing separately, spouses, where only one spouse does the homestead declaration, which is totally legitimate. That happens. You have a couple thousand married filing separate, usually. Overall, there are people.
Sorry, go ahead.
There are people who file in a resident income tax return but don't do a homestead declaration. It could be that they're thinking they're going to sell their house, so they don't do it for that reason. Maybe they think they're going to be away for more than half the year, but they actually end up being here for more than half the year. So there's situations where that happens. If somebody's reported on a household income form as an other person, I would have been able to connect them. But there's possibly situations where either you have somebody living in your house who you don't report on a household income form because you have messed up the household income form. You don't really know what you're doing. That's a possibility. Another possibility is that your income is very, very high. So you're not filing for a property tax credit anyway. So even though your cousin, Jimmy, is living in your other extra bedroom and making $50,000 a year, they wouldn't show up.
What if it's not your cousin Jimmy, but it's your partner that you're carrying the mortgage with?
If it's your partner, like married partner?
Unmarried partner. So you would be filing separately and one of you would be putting the homestead on your tax form because someone has to. But both the incomes wouldn't be listed there because you know that you're not listing your income on it because you know you're not going to get an adjustment.
Right, so that the partner could disappear from,
Okay.
I wouldn't be able.
And do we have any sense of how many Vermonters might be living in situations like that? Like I know that marriage rates have gone down and.
It's probably not that many.
Okay, great.
Of the 126 million, I'd say most of that is coming from renters. Probably the majority of it is coming from renters. And then these other situations are probably pretty small share.
And how many people are in that 29%?
I have to send you that. I'll send that this afternoon.
And I'm asking because I'm wondering if you check that number against sort of what we think the number of renters in Vermont is based on census data.
We have 75,000 renting households. Renting income tax filers, I'm not sure that.
Yeah, I'm just curious how.
Right, so.
Okay.
And then one interesting thing that sort of related to what you guys were just talking about before I sat down, when you do your 2019 homestead declaration, you file a property tax credit claim based on 2018. That's the lag. You're looking back to your prior year household income and your prior year of property taxes. When I did this, I looked at anybody who showed up on that property tax credit claim, but that claim would have been looking back at 2018. So you could have a situation where, my spouse and I filed this property tax credit claim for 2018, but then in 2019, cousin Jimmy moves in, and cousin Jimmy goes on to file a resident income tax return. So that would also not show up here. And that's the entirety of it.
Okay. Yeah.
These percentages are based on the amount of revenue does that roughly correlate? Do you have any sense of, is it a pretty good match to just number of filers or you know what I mean? The 7%, basically this 35 million is coming from people that have to file but are not resident, right? So, a lot of them would end up contributing today through the sales tax, but I'm just wondering if I'd love to understand how many people that is relative to owners.
Yeah, I'll send it over this afternoon, the counts. So it shouldn't really correlate with counts very well because the homestead population is probably higher income.
Yeah.
So these are based on revenue and not counts. So I'll send those over.
And just want folks to remember, so this sort of categories and conversation really matches up with the second half of the PowerPoint presentation that Graham and Julia took us through at our last meeting, right? That was our last meeting.
Yeah.
And what I've heard from you is this, is very close to sort of what they estimated. So this is in some way just sort of like a confirmation with a more ideal data set of some modeling that Graham and Julia did already.
Yeah, my understanding was that you were sort of interested in knowing about a new tax, like people who might be exposed.
Absolutely, yeah.
Okay. Dave, we've got an estimate for how many renters we have. And I assume we know how many renter rebates we gave out because those are limited to lower income people. I'm trying to figure out, not all renters are poor. There's some folks that rent some pretty nice places, maybe because they haven't found a house, or they're only going to be here a few years. Do we know what percentage of this percentage are higher income rent? Because one of the things that's been thrown out is exempting renters from the income tax, because in theory they're paying it in their rent. But I think I'd get pretty upset if my son, who was making $200,000 a year, wasn't paying income tax and I was,
Well, yeah,
because he's renting.
I don't remember us suggesting they would be exempt.
It's been
We've sort of,
thrown
the
out.
way I've thought of it is you get a credit against your liability based on your amount of rent you're paying.
And we're going to talk about how we might want to exempt renters a little bit further in the outline. This was just, and like, I appreciate the conversation starting. I just want to sort of flag that that's like, we are going to absolutely figure that out. This is just getting clear on what information we have to make that decision with. So I just want to see if anyone has any other questions about the actual information that Jake's sharing with us.
Jake, do you know how many people get the renter rebate?
Yeah, we do. It's between 10 and 12,000 receive a credit. There's about 75,000 renting households. The best source for their income breakdown is the census, and JFO and has that. I think they might have showed it, or I might have showed it at some point.
Yeah, okay.
So we have 75,000 renting households and 10 to 12,000 who get a rebate. So the majority of our renters are not poor.
Well, I guess it depends on what you define as poor.
Poor, yes.
Yeah.
Well, that's like withholding.
And
it's not a lot unless I needed to buy groceries.
Well, and the renter rebate, the new one, is really like a much lower, higher threshold, or
Yeah.
I mean, I don't know how to describe it, but it's a more narrow group of people than the old renter rebate.
Can I ask Jake a question about the calendar years? Or do you
Sure,
wanna-
go for it.
I don't know if you were listening to that discussion, but one of my questions on whether we should do the 6-month delay and have it on the next year's income or not is if the tax department would have an opinion on administrative difficulty or an opinion on the matter, whether it's administrative or other on that question.
I think specifically, how long does it take you to come out with tax tables, and how far in advance do tax software companies need that information?
Right. Or anything else
Yeah.
that I might not know.
Yeah, I sort of heard some of it. What is going on up there?
It's actually outside of Senate Finance.
Foundation work.
Building stuff.
Oh,
I think it's part of that whole stair.
That's probably their lunch right there.
the tax department produces withholding tables in November for the coming year, and then we distribute them to the different, software companies that handle withholding for employers. So in November, I did the withholding tables for 2023. And they should be sort of implementing them right now or getting them set up. And I think maybe you were talking about a July start for a new withholding schema. That would be tricky. As far as I know, most state or all states, I think, are on the calendar year. I'm not aware of a state or a municipality where they have a new one coming out in July. It doesn't mean it's not possible, but I think it would be unusual. And it might present some challenges, beyond just us producing it and communicating it. I think you maybe want to talk. I'm not really doing a good job of anticipating what the challenges would be exactly, but I do know that right now we do it in November and then they kick in on January 1st of the coming year.
So in a situation like that, Jake, so this, we're talking about something that's predicated on the statewide average from the previous school year. It starts on July, before that November. So in that case, it would seem to me like in November, the tax department could just say, you know, hey, what was the statewide average that was voted on earlier in the year? And you would just send that statewide average number to the software companies, and then they would start withholding that in January.
They would need to know the town of their.
We're talking about a statewide average, a statewide withholding number.
Oh.
Yeah, it would just be one.
Yeah. So you vote in March or April.
Yeah.
And then in January, you'd see a change to your withholding based on.
Right. Based on what that statewide average was of all those votes in the first part of the previous year.
Preliminarily, I think that would be much easier than a July 1st start.
Yeah.
But I have to think about it some more, because that would be a companion table to the one we produce, I think, right?
Yeah, I think so.
Is that different than what we were talking before?
Well, and maybe I got it wrong. I was going to try to, but what I thought we were talking about before is that we would vote in March, and then the withholding would be taken out the next calendar year, tax year. But then you wouldn't actually pay the tax until the next filing season. So in other words, I did think so. In other words, you would vote in March of 23. That withholding that reflected those would take place in calendar year 24, and then you would file in April of 25. I thought that's what maybe I got.
I guess I wasn't thinking of it that way.
Yeah.
Maybe I got it wrong.
It's different than what I thought you said it.
I think, to put this on your radar, there's something you would be reconciling if the withholding is happening through calendar year 24, you'd be reconciling in March or when you file in 2025. So that's like 2 years after you voted.
Right.
So that part, not an administrative problem, but a understanding education taxes.
Did I understand that? Maybe I understand.
I guess it's.
I don't know, I wasn't.
It's a there's the reconciliation issue, but it's not like you're not really filing for that 2 years ago, but it would impact the tax.
You're paying the tax 2 years after it was.
After you voted.
You're always paying the tax, but once we get it going, you're always going to be paying it.
But the difference will come if there's a swing, up or down in either spending.
Yeah.
Say all our schools turn out to be contaminated and they have to pay to clean it up, or the national worldwide economy bottoms out and the sales and income tax drop dramatically. We voted here vote in March of 2023, we start spending in July of 2023 now.
This is what I was mentioning.
We would vote in 23, but under this scenario, we would start spending in 23 with the new school year, but we wouldn't start paying until January of 24, which means if there's any swing up or down, up is probably not a problem because you get money back. But if there's a swing down, and that comes to the, still that we seem to have said we want to hold schools harmless as we do now. We want to give them stability or some level of protection from economic cycles.
For the treasurer, what kind of, if spending's going up, it normally does. Okay, and you're not paying that 23 decision until 20, I mean.
That's what the reserve,
Right, that was my question about the reserve. Would you be using the reserve much more?
so now that I actually see so this is what I was describing. And now that I see it, when I was thinking about it yesterday, I hadn't actually written it out like this.
That's
Now
what
that
I
I
thought
see
you
it,
said.
now that I see it written out like this, I'm like, that is actually way too long.
But
It is
how do you,
years.
if you start in July, you still have that reconciliation in the tax year in April. I mean, I guess
Right, you're still in the same school year. That's exactly right.
yeah, but if you're withholding, but your withholding might be, you start in July, but
What I don't understand is you'd be reconciling two different rates. In April, you'd have been reconciling the first half of that calendar year. The second-
That's, I think you have one withholding rate for the year, so you can satisfy the software.
Yeah, I think you'd have to have one you'd have to have the first
And then
withholding rate for the
at
year.
reconciliation, if something was a little askew because we have this calendar year requirement, that gets settled at filing. It could go, I mean, I don't think it's going to go big in either direction, but there's going to be some play in there.
So you're withholding based on you're basically withholding based on the prior year's rate and you're paying based on the current year's rate.
as long as it's just, I think it's just keeping on a
thank you.
calendar is the important part of that.
Yeah, the problem is the school budgets aren't on that.
Yeah, but I think once we get it going and we have a big enough reserve, if we can have a big enough reserve, then.
Well, it's not just the size of the reserve is necessary, but it is also it is a 2-year disconnect between a decision that you voted on and your experience of paying for it. And we have said a bunch of times over that our goal is to connect those decisions more closely.
So what would you do otherwise?
I would do that what everyone is saying other than me before, which is that you
Start in July?
withhold based on Julia, please.
Withholding January through December.
Yeah.
Yeah.
Just wanted to make one point about looking at reconciliation of the prior year. You would still need to reconcile two separate rates. So one potential way of approaching that is to use the effective tax rate. Otherwise, you could set up a situation for sort of gaming income, because you could have a lower rate perhaps in the beginning of the year and the second half of the year would be subject to a higher rate. So if you're reconciling that entire year, you would probably want to use the effective rate.
Yes, thank you.
I'm thinking more for folks who are receiving payments necessarily than wage earners. They don't have as much control over the timing of.
Sorry.
That happens now with calendar year.
Well, it would be, since you have it would suddenly be creating two separate rates throughout the year.
But I don't think we can do that. I mean, I don't think the software companies will let us do that. I think we're stuck with one rate for a calendar year.
For the withholding.
The withholding.
Yeah.
Speeding more towards the actual
Oh, okay.
calculation of the tax liability the following April.
Yeah, that's what I was, yeah.
Which rate would you use? Would you look at applying it at a different rate on different line of income, or just look at one effective rate?
I think you use the rate that's assigned by, I don't know who assigns it, the tax department or AOE. We make all of our decisions in April and May about what and then is it the tax department that determines what each municipality's tax rate is? I think so, yeah.
Yes.
And the tax department, sends that out to the town clerks, and the town clerks generate bills. I think you use that rate and you apply it to that year's income.
Okay, one second. Jake, do you want to add to this conversation, or would you like to not sit there anymore? It's totally up to you. We have pivoted from the conversation that you were sitting here for. You are
Yeah,
welcome
yeah.
to stay here for this conversation. I just want to also give you the option of leaving the table if you would like.
I'm always hesitant because I don't want to get myself into trouble. This is this is something that we also pondered too, how it would work. We didn't have a good solution when we pondered it. So, it's not like I'm sitting here with a magic answer for you and I'm just holding it in. I guess if you're going to just use averages and not make it town specific, then you could just start on January and then reconcile the following March. So how that plays out is like, January 1st, your state income tax withholding is going to move a little bit and your state education income tax withholding is going to do something. And then in March, you would vote. Nothing would happen on your withholding. And then the following March, or April, when you file your income taxes, you would reconcile. That's the most straightforward approach, but that has the problem of, at least in my opinion, of people voting and then not seeing any effect.
Yeah.
And right now, it's like Senator Pearson was describing, you vote in March or April, and then there it is in July. Not that you can make sense of it, but you just voted.
It's more immediate than the next year. And when you say reconcile, we've got my income tax, the one we have now, that is withheld and I pay. Now we're going to have a separate education tax. I'm going to reconcile my education tax against my education tax, or is it, how are they going to interplay? And then what happens if I owe child support?
Senator Cummings, that conversation is later in the outline. We're not having it right now.
Outline, all right.
So Jake.
Wait, Senator Pearson is up.
Jake, some communities have a local income tax, like a city tax, right?
Vermont.
Not in Vermont.
Not in Vermont,
Yeah.
but around the country, right? And you probably haven't looked at this, but would it be possible to have a quick understanding of how those communities deal with the software issue? And are they just disciplined enough to always make it January 1? And you know what I mean? I would guess some of their budgets are not calendar budgets, but I have no idea. So I don't know if there's maybe some lessons that we could draw from those examples.
I could share with JFO some articles I have on municipal income taxes. It's mostly Rust Belt, and Philadelphia has a pretty well-known one.
Doesn't New York City have one?
Oh, yeah.
The city does, but you pay it to the state when you do your regular income taxes, I think. I don't know the year schedule, but I think that it's probable that it's on January start, because remember the feds update their withholding tables on January 1st. So, that's the main, main income tax that people pay. And so it's likely that everything is operating January 1st.
Local option, I mean, we allow certain local option taxes, but
Not income.
they're all kind of just melded into
If we learned that Philadelphia had some deal with the software companies to deal with even a different fiscal year, that would just be valuable to understand. And probably not, but if you wouldn't mind, if that's an email away, that I'd be grateful.
But Jake, to your point that, somebody could vote on something and then they wouldn't see any change in their withholding. That's how it works for escrow payers right now.
Mm-hmm.
Yes, but they still get a bill in the mail. So they may be paying through escrow, but,
That's true.
There is a lag.
They do get the bill.
Mm-hmm.
Yeah.
Yeah, but something Senator Cummings mentioned that I also brought up in that presentation from way back about reconciliation is that it would be awkward for taxpayers if they had this regular income tax and an education income tax, and they had a $500 refund coming to them on the regular.
I think we're going to talk about that this afternoon.
And a credit and a debit.
Yeah.
Talking about it this afternoon.
Okay.
I need McDonald here because I'm sure he could figure out how to game that system.
I think it's all, that's all very figurable, what we're talking about this afternoon. So we have two options that I think we've talked through fairly extensively. One, we don't have a whiteboard, but we have Scott's pen drawings.
We do what you do. I mean, that's
These are Scott's, I know, I will hand it around, but basically one is that we sort of have the withholding rate based on the previous year and then the effective rate in April based on sort of the 2 years blended. And the other is that we are using a full year's rate on a year-long delay, which creates 2 years between when the vote happens and when someone's reconciling that payment. I will send this around and would just love to see if maybe we can all come to an agreement on which one or the other, and like conversations with tax filing software can happen after that.
And the top one there can still do the January to December. You don't,
Both systems can live within the existing constructs of American taxes.
Yeah.
Though I did read a really interesting article about taxes.
Texas or tax?
Texas or Texas?
Taxes and Falklands that I will share around.
What's that, the man with a plan? Love Texas.
It's the Faroe Islands, just for the record.
I understand the bottom one. I guess I'm not, I'm still unclear
Okay.
on the difference, but I like the top one. It's, the way it's described, it seems more connected to the budget. And
Okay.
my main concern was the January to December thing, so if,
Okay,
blended rate.
yeah.
Yeah, I guess, maybe this is a question for Jake. I mean, this is always frustrating because it sounds simple and you'll probably tell me why it's going to cost $4 million. But what if there was a letter that went to taxpayers, after the legislature acts, after the vote, after we set our rate, so that this blended rate was felt in the sense of, you live in Brattleboro, here's what we would anticipate your, something like that.
you know what's nice is that we're already spending that money sending a letter to everyone, so.
Are we?
Yeah, we all get property tax bills.
The towns do that. Well,
But we're actually, okay, that's a good, let's flag that as a, okay, let's flag that. I think that's an
Just
interesting idea.
still get your municipal tax bill and this letter from the state.
Let's
Council will love that. Oh, thanks.
Okay.
All this money and giving us a letter.
Yeah.
So it seems like everyone is moving back towards A. I am on A
I
now.
don't consider it back to, I think it's
Yes,
a good idea.
great. However you want to frame it. I am moving towards A.
Is A the top?
Sure. I think that's how it was in the bullet points, right?
That's
1 and 2.
That's how I
Sorry.
read it.
Yes,
I
okay.
guess I was reading.
It's potential option 1 and 2 is the top and the bottom. So what do people think? We agree on 1? Great. Yeah?
Yeah.
I mean, we're not voting. We're just trying to create a draft report. Okay.
I think it works with the software, which is really important.
Yes. Okay. Thank you, Jake. Julianne, Abby, is there a bullet point that you anticipate we could discuss in 15 minutes, or would you recommend we take lunch?
I did quickly look into the difference in the average weighted rates.
Oh.
Okay.
So,
Would you like to join us back at the table? Thank you.
For the record, Julie Richter, JFO. And you had all asked me when we're talking about this bullet point at the top on page 5 and thinking about if you do use a statewide average rate and how would that rate be weighted? What is the difference in rates that we're actually looking at? I haven't had time to look at the difference for taxpayers, but I quickly looked through our FY23 yield model as well as our FY24 yield model. You're looking at about a 1 cent difference in the tax rate when weighting.
Between the weighted and the average.
Weighted overall, weighted by towns and weighted by districts. So Representative Beck, you were saying it wasn't going to be that big of a difference, I believe, and that's what it seems.
Less than 1%.
For the last 2 years.
Okay.
And what about were you able to look, so if we peg it to whatever that is, it's sort of not a big difference. That's what I'm paying, and then in April, we say, but in fact, you live in a high spending town. That's the deviation that I've been trying to understand.
So I think that deviation is very granular. We would need to look at,
Well, isn't it straightforward to figure out the average versus the high point, the low point, the low spending?
Take the highest spending
Yeah.
town.
I mean, sure, and that's about to change really, really dramatically. So I know we haven't talked about the weighting bill very much in this committee, but like the makeup of which towns are high spending and low spending on a per pupil basis is about to like.
Condensing, right?
Well, it's flipping, it's condensing, there's like,
But we don't care which towns, we just want differential.
the difference is going to change a lot.
I don't think a statewide, if you said a statewide average, it's, maybe I'm misunderstanding the conversation. A statewide average would not be the average of the high and the low. It would be the average of all.
Yes.
No, I understand. So what I'm wondering about is we're setting up a withholding scheme.
Yeah.
And then people are going to face the music in April. And half the people will get a little bit back because their towns are under average spending, and half people will get something. They'll have a bill due. And I'm trying to understand, or we might further refine the withholding amount. That's been some of the discussion. And I'm trying to understand how much of a hit somebody would expect if they're in a high spending town, and we've been withholding based on an average.
I think that ultimately depends on the taxpayer. So the way that we've envisioned this withholding scheme would work is that taxpayers would choose which tranche they would fall into in accordance to the statewide average. So if a taxpayer is looking, every taxpayer can look at what their district, what their town tends to do. And if they are a high spender, then they can say, okay, then we're going to be withholding
Or
a greater amount.
Yeah. But let's say they chose 100%. And I mean, maybe we would have that default of your withholding. So you'd be withholding based on 100% of the average. I'm just trying to understand.
I get your question.
Are we looking at a $4,000 surprise or a $400?
I think I'm having trouble.
Go ahead.
I think I'm having trouble answering the question because it's going to be depending on where the taxpayer is living, what their income is, what they're choosing, or even if they're at the 100%. There's a lot of.
Well, think of it this way. There's an average that's a dollar figure. Is the highest point 1.5 times the average, or is it 1.3 times the average, or 4 times the average?
But we don't just have a rate per town the way we do now. We also have a rate per income bracket. And so there are more variables.
That's taken care of. I'm going to say, I'll I'll take the 100% tranche, right? That means I'm going to be submitting I'm asking, I'm going to state this, but I think I'm really asking a question. If I select 100%, that means that I'm going to be paying, based on my income, the amount that the state assumes would be necessary if I lived in a district with an average spending.
Yeah.
But almost nobody lives in a district with an average spending. It's the average. So let's say I actually live in the district with the highest spending. What is the gulf between average and that's the amount I'm trying to understand. Because I'm not convinced too many taxpayers will finesse.
It'd be whatever percentage your district is above the statewide average. It could be 20%, you know.
Well, that's what I'm asking.
Yeah.
And you would know what your district was above the statewide average because that's the publicized information.
Yeah.
And then you would decide if you should be at 100% or 125%.
Yeah.
So then it would be.
Let's say I'm not so good at that.
Yeah, no, yes.
The average taxpayer.
What would I anticipate the April surprise?
Well, let's say you're 150% of the statewide average. I mean, that'd be a really high spender, right?
Well, this is my question.
Yeah. Okay. So
What's the max?
So in that case, if we're using these numbers that or just, you know,
Yeah.
we're playing with, right? Okay, so then that would be if you were in the highest bracket. Let's pick somebody in the middle. The person that pays the person that pays 2%.
Yeah.
Okay, then that person should have actually paid 3%. So one person. So let's say they make $60,000 a year, then they're getting a bill for $600.
Okay.
Or, but the surprise is 600.
That's the surprise. It's $600. Yeah. Right.
Whereas right now,
Yeah.
they vote in March, they get a bill. It's the common level of appraisal that seems to throw those bills.
Oh, yeah. Okay.
That's, you know what you voted, you know you only went up in 1% in spending, but your tax bill went up 10% because of the CLA.
Yeah.
That, you get the full thing right now as a surprise.
Yeah, no, I like that. And Scott, you're helping me because it is, even if it's double, it's still 2%, right? If we're based on a 2%, it is a fairly small percentage. This could be a big number.
I mean, probably 80% of our districts are within 10% of the statewide average, probably, just guessing, you know.
Right. So it's 22% surprise. Yeah. Okay. Is that?
Sure. So I was just quickly looking while you were talking. I might have missed some of your conversation, but I was trying to look at, okay, in FY23, if we look at the adjusted education spending per equalized pupil in each district, what is the variance? Which is what I understood your question to be. And so when I pulled the minimum, the school district that spent the lowest amount of ed spending per pupil and the school district that spent the highest amount of ed spending per pupil, and I compared that to what was the average across districts. It wasn't a weighted average, it was the average across districts. I have that the maximum was 146% and the minimum was 66%.
Yeah. Okay.
Does that answer your question?
It absolutely does. Thank you.
Which was higher, the statewide weighted average or the statewide average? District average?
The district average a little bit higher, but I was only looking at FY20 when I was looking at the difference in the weighted averages. I was only looking at FY23 and FY24. So of course, with my always caveat, it depends on local decision, so that could be different.
So did you say the district average was slightly higher than the weighted average?
Correct.
So that follows, so that indicates.
But this is a 0.4%.
Districts spend less per pupil, yeah.
Okay.
0.4% surprise.
Yeah, not much.
That's all I'm looking for is
Yeah.
just to.
Yeah.
You know.
So given that it seems like there's not that much of a difference between the two decision points, my temptation would be to stick with the way we average currently, because that's how we currently do it.
I agree.
Seems like we're changing enough things.
Okay.
Yes? Okay,
Makes sense.
go team. After lunch, we will discuss the renter credit. Right? Is that, wait, Julia, Abby, is that the next thing on the outline?
What haven't we done?
Yeah, and just to make sure, we're trying to keep track of all of your decision points. I'm looking at the top of page 5, and I understand that keep it as it is currently in terms of weighting, so the overall state rate based on population, or really based on number of households. But this, with respect to the second bullet point, would the prior year's rate be adjusted based on the effective tax rate? Is that what the committee decided?
We decided on option 1.
Potential option 1.
Yep.
And that's sort of a blended tax rate.
No, sorry. Yeah, yes, that one. Yes, 1. Yes.
Not for the.
1 is the top picture in Scott's thing with.
So we actually have 2 potential option 1s, which is maybe a little confusing.
Okay.
She's talking about.
We understood the potential option 1, which is the blended, the effective tax rate. And my question is referring to the first potential option 1 that's listed on page 5, which is would the prior year's rate be adjusted by? For withholding only.
It would, the withholding, the way I read this is it would be based on the statewide average from the previous year.
And do you want to grow that statewide average at all?
No.
No. Okay.
Do people want to? I don't.
What do you mean grow it?
Average.
Assume
Assume a.
Assume that the statewide rate is going to be bigger than the previous year, and if so,
Okay,
what
sure.
growth factor?
Because otherwise we're gonna, we would, ideally, we would have the smallest April surprise possible for people.
So
There's an inflation factor that's the most tied to schools of the inflation factors.
So there is the NEAP,
Thank you.
which is included in places in Title 16. There's also the idea that we had, which would be to look at the annual change, the forecasted annual change in ed spending per equalized pupil. It's really just a policy.
That's already happening.
that's what you do in the December 1st. That's part of the December 1st letters.
I mean, this is just really for a point of accuracy in the.
Withholding. Yes.
Right.
We're still going to adjust
Yes.
the rates, yeah.
We're way down in the weeds right now. Yeah.
Currently.
I guess the projected spending makes more sense than arbitrary inflator, doesn't it?
Yeah.
Okay.
Yeah, but if that's what goes into December 1,
It won't be ready in time
No, it
for
won't.
withholding tables. It wouldn't be ready in time for withholding tables if it's based on the December 1st letter.
Would be based on the calculations, not the letter
You don't have to
comes
wait
out,
for the
but
letter.
you,
Yeah, but
the
the
calculations can be done earlier.
Sure, but they're not.
But I don't think that, I don't think AOE and tax have, they don't have in October, November, and they're sending in their expected expenses to Brad James, and he's, I don't,
Doing
Yeah,
whatever.
so
yeah, I don't think that's
December
right.
1 letter, the EF Outlook that we just published, Jake and his crew, that's all based on forecasts and projections that we receive from different folks. Brad James being and AOE being a big part of that.
I don't
And
think.
doing that earlier seems,
Doing that earlier, I don't, from my personal experience, don't really see that
Yeah.
being possible. We are really up against crunch time
Yeah.
this week, hence my maybe slow response time to some of your questions.
You say that out loud, Brad James might be in here this afternoon.
I don't know quite the options we're discussing, but the December 1 letter which is a prediction, and what we actually do has not had a lot to do with one another in my experience. Leaders. So I would be reluctant to publish withholding tables based on that.
that's a good point.
I guess that
I don't know what a better
question is really,
Should you?
sounds like the committee has decided to do withholding based on previous year overall average statewide rate. And then the question is, do you want it to be that period, end of story, or do you want to include some factor to make that rate a bit higher for the coming?
I think we all want to include a factor and we don't know what the factor is.
Okay.
I'd say NEEP unless you can tell us there's something better to use.
Need December 1 or that's different?
No, NEEP is based on,
Just an education inflator. Yeah.
I don't
Is
know.
there something better to use? It's what we used to use the excess spending threshold. Well, we still do. But we don't-
Don't do that.
we don't apply it right now.
Okay.
okay,
Better to get a return than, oh.
thank you.
So for now, unless someone has a light bulb moment over lunch, it sounds as though you're interested in the NEAT.
We're, I think we're feeling tentatively towards the NEEP, but
Unless you
we,
tell us there's a better
There's
one.
a better one, yeah.
Or you get a light bulb moment, or some little bird talks to you during lunch and tells you.
Okay.
We're all not thinking about
And-
this, so we'll get no light bulb moments during
and
lunch.
I'm going to think about it, nothing else during lunch. What, so when we get back, our next step is the renters.
Yes, and
Okay.
there were some questions about, and there were more actually in the administrative section that I glossed over perhaps too quickly about what would happen with the interplay of a refund from the education tax and other potential taxes. So
And I think that's, yeah,
I had actually moved that, so
yes.
go backwards in time on this list.
Okay, cool. Thanks. Okay.